Hi, this is Kurt Kringelis, Senior Credit Strategist with ING Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. As is often the case, the fixed income markets finished the year by delivering healthy excess returns in December. Last-minute uncertainty surrounding the Fiscal Cliff negotiations weakened the equity markets but did not cause much of a pullback in the fixed income markets. The highest risk sectors performed best during the month. The highest risk sectors also performed the best during the 2012 calendar year. The high yield and emerging markets delivered excess and total returns of approximately 15% for the year. Within the investment grade corporate market, the cyclically oriented industries led the market during the year-end rally. The communications industry also outperformed. While the financial industry was not the top performer, as was often the case during the year, it still outperformed the market during the month. The strong performance of the technology industry was a bit surprising given the lower beta nature of this industry. On a year-to-date basis, the financial industry was the star performer for the year. The financial industry not only closed the year as the only outperforming industry, it outperformed the market by over 500 basis points with a full-year excess return of over 1,200 basis points. The communications industry roughly tied the market for second place with an excess return performance of about 725 basis points. The full-year excess returns for the remaining industries were generally clustered in the 400 to 550 basis point range. Despite a strong December, the low beta technology industry was the clear laggard with a full-year excess return of only about 200 basis points. The corporate market rewarded our risk-on bias as performance rebounded despite persistent uncertainty surrounding the outcome of the Fiscal Cliff negotiations. While the Fiscal Cliff was averted, a grand bargain was not reached. Still, we expect the market to respond positively in the near term, but volatility could come back into play later in the first quarter when the debt ceiling debate begins to take place. Spreads in the corporate market tightened 92 basis points during 2012, falling from 233 basis points to 141 basis points. Spreads are now near the low point of the past 3 years and are near the long-term average, so sustained economic growth and constrained tail risks will likely be needed to support lower spreads. Under these conditions, excess returns in 2013 of perhaps 100 to 200 basis points are possible, but we do not expect excess return performance to be as strong as it was last year.